This is Nightly Business Report with Bill Griffith and Sue Herrera.
Wait and see. That's what investors seem to be doing as they look for more clarity on two big issues: shutdown talks and trade.
Tax surprise as filers calculate their taxes. Some say it's not what they expected.
Aging in place. More older Americans are doing it, but it's complicating things for potential home buyers. Those stories and more tonight on Nightly Business Report for Monday, February 11th.
And we do bid you a good evening, everybody, and welcome. Investors spent much of this day watching and waiting. They anxiously watched the government shutdown meetings in Washington and those discussions on trade in Beijing. And they waited for new developments on both. With earnings season winding down and the Fed apparently on hold, the government spending battle and the trade talks are now the two most important events for the market. But today, after all the watching and waiting, there's still only fog. And that resulted in a mixed finish for stocks today. The Dow fell just 53 points, never strayed very far from unchanged. The Nasdaq rose 9, and the S&P added just 2.
So let's begin tonight with the shutdown. Lawmakers from both parties met this afternoon after reports over the weekend that budget negotiations have stalled. Remember, the deadline to fund parts of the government is this Friday. The sticking point remains border security. If the president doesn't sign a deal into law by the deadline, parts of the government will shut down again. Elon Mui is covering the story for us from Capitol Hill. Good to see you, Elon. Where do things stand at this hour?
Well, Sue, the negotiations are going on through the evening. As you mentioned, the top two Republicans and the top two Democrats on the shutdown committee did meet this afternoon to try to restart some of those discussions. Now, they came out of that meeting, at least the Democrats did, sounding fairly optimistic. Democrats have offered to pay more money for physical barriers in exchange for limiting the number of detention beds used for immigration enforcement. Republicans, however, have called that a poison pill and a non-starter in these negotiations, so we will see if they are able to break through this latest logjam.
So what are the federal workers telling you right now? I mean, they've already been through what was once the longest shutdown in U.S. history.
Well, they're certainly not very happy. What we heard today was workers saying that they want lawmakers to reach a deal. They want to make sure the federal government stays open. However, it has to happen. We saw workers fanning out across Capitol Hill today to take that message to lawmakers, folks at the Bureau of Prisons, folks who work for the flight attendants union. They all had that same message. They've been through this once before. They don't want to be here again.
Understandably so. Elon Mui on Capitol Hill. Elon, thank you.
Now to trade preparations. They are underway ahead of an important meeting later this week between high-level officials from the two world's largest economies. Those meetings are taking place in Beijing, and that's where we find our Eunice Yoon tonight.
The trade talks are underway here in Beijing. Deputy-level officials have arrived and are setting the stage for some of the higher-level discussions for the Trade Representative Bob Lighthizer and Treasury Secretary Steven Mnuchin. The talks last all week, and by the end of it, we should have a much clearer idea if a deal is in the cards by March 1st. China today said it's hopeful for a good result, but the big question is, will the Chinese make major concessions on issues that are important to the U.S.? Structural issues like state subsidies, forced technology transfers. So far, they haven't moved much, and the dominant opinion among China watchers is that the Chinese won't move on these issues. They don't like the outside pressure, and they consider industrial policy too important to give up. The other opinion, which is the Trump administration's view, is if the U.S. squeezes China enough economically, when the economy is down, Beijing will come to the table. And on that front, we got some data which showed the consumer isn't so confident here. Lunar New Year sales grew at their slowest pace in more than a decade. The sales are a gauge of the Chinese consumer, China's equivalent to Christmas shopping. Retail sales and domestic travel dropped to the single digits. And that could put pressure on the negotiators on the Chinese side. For Nightly Business Report, I'm Eunice Yoon in Beijing.
So we have the trade talks in China, shutdown negotiations happening in Washington, and data, inflation data out later in the week. All of these could potentially be events for the market in this new trading week. So Kevin Caron joins us, Senior Portfolio Manager with Washington Crossing Advisors, to talk about this week ahead. Good to see you, Kevin, as always.
Good to be here.
Of those that I listed, which do you think is going to be potentially the most market moving?
It's got to be trade, because it is the biggest issue, and it's been a lingering issue for the global economy and the financial markets for most of the last year. So I'd have to finger trade as being the biggest potential worry, but all of the others, the shutdown does have implications because it pushes up against the debt ceiling ultimately. And then later in the month, we're going to be confronted with Brexit. So there are a lot of events that could move the market one way or the other. You
would think that after the long shutdown we had and the implications it has for the economy, that they would find a way to avoid it. Although what we are hearing is that it's entirely possible that they just sign another continuing resolution and kick the can down the road.
Yeah, the market also has been rallying into this. So with all of these events, it seems as if the market is expressing the idea that cooler heads will prevail. Of course, these are all thorny issues taken one at a time, and the debt ceiling and the shutdown, or the potential shutdown, is among the thorniest. So we'll have to see how it goes, but it has a big impact on market psychology, that's for sure.
What about data? You know, we had that big Fed meeting where it looks like we won't get the kind of rate hikes that the market had been factoring in before this new year. How important is the data?
Well, the data is very important. The Fed essentially gave in on the idea that the economy was overheating and has folded into a much more dovish Fed, and the outlook has been reduced in terms of interest rate increases. So if we got, for example, inflation data that suddenly was to run hot, that might put pressure on the Fed to come back and begin raising rates again. That could be a problem. So yes, the Fed is going to be paying very close attention to the data that comes out on inflation and retail sales and consumer confidence in the next several days.
By the way, before we let you go, we've highlighted on this program in the past the consumer staples sector, which was highly regarded over the summer as a defensive move, defensive sector. But with the rally we saw in January, a lot of people were moving away from those defensive sectors. You still like consumer staples, don't you?
Yes, at Washington Crossing Advisors, we have a barometer that we've constructed that measures changes in the economy and financial markets. And from about a year ago, we began to see a decline in that barometer, and we followed that. And so our best indicators at this point are suggesting that we still need to be somewhat cautious. We have not seen a turn in the data yet, and so consequently, the consumer, a more steady part of the economy, or even utilities where yields have backed up, to us seem very attractive.
Kevin Caron, thank you. Kevin is with Washington Crossing Advisors.
Well, exchange-traded funds, believe it or not, have been around since 1993, but it's only in the past 5 years that their popularity has grown exponentially, now with more than $3.5 trillion in assets under management. So it's no surprise that influential investment managers are attending the annual gathering of the ETF industry. And as Bob Pisani reports, a few key themes are emerging. He's in Hollywood, Florida for us tonight.
I'm here at the 12th annual Inside ETFs conference, the biggest ETF conference in the world, where roughly 2,500 investment professionals are gathered to talk about the most important trends in 2019. Chief among them, concerns about a global growth slowdown. It's the #1 topic here. But the head of the New York Stock Exchange says that optimism about growth in the U.S. will help outweigh the slowdown in Europe and in Asia.
When you mentioned Davos, when I was out there, it was apparent that there was a little more optimism from some of the U.S. CEOs than there were from some of the European CEOs. And again, there are just a lot of issues that are unfolding. And so how they unfold and how quickly they unfold, I think, is going to contribute to what that growth looks like.
But while many have downgraded their forecast for growth here in the U.S. and abroad, one key player says that a recession is not imminent.
We upgraded our risk of a recession in 2019 because of policy uncertainty from 30% to 35%. We see the risk rising as we go into 2020, where we expect it to be somewhere between 40 to 50% chance of recession in 2020.
And finally, I sat down with investing legend Paul Tudor Jones, who is looking to make a big push in another theme that's gaining traction among ETFs, socially responsible investing.
Since 2008, 92% of corporate profits have gone to shareholders. It's the exact photo negative of what the American public thinks a just company should do. So we've got this big disconnect between what the American public thinks and what corporate boardrooms, the C-suite, are actually doing.
Jones believes that the American public strongly supports the principles of socially responsible investing, which includes fair pay for workers, reducing pollution, and creating and maintaining jobs. That's all a far cry from the old mantra that the sole purpose of a corporation is to maximize return for shareholders. For Nightly Business Report, I'm Bob Pisani in Hollywood, Florida.
It is time to take a look at some of today's upgrades and downgrades. Tesla was upgraded to buy from hold at Canaccord Genuity. The analyst cites improving demand for electric vehicles. The price target is $450. The stock rose more than 2% to $312.84. Electronic Arts was upgraded to buy from neutral at Bank of America Merrill Lynch. The analyst cites the positive reception of EA's new game, Apex Legends, which we told you about last week. The game is considered a rival to Fortnite. The price target is $110. Despite the upgrade, though, the stock fell a fraction to $97.24.
Avis Budget was upgraded to buy from sell at Goldman Sachs. The analyst cited the stock's valuation and potential benefits that will come from the company's cost-saving efforts. Price target now $35, and that stock rose more than 7% today to $27.58. NVIDIA was downgraded to market perform from outperform at Bernstein. The analyst says that the semiconductor company is facing severe challenges to growth. Price target $175, and that stock fell another 1% today to $146.45.
Coming up, making a comeback, stocks that were kicked out of the Dow and are rebounding strong. We'll tell you which ones and why this tends to happen.
Very late today, Amazon said it's buying a Wi-Fi startup called Arrow. Arrow makes home routers to help customers better connect smart home devices. Terms of the deal were not disclosed. As you know, Amazon has been making a big push into the smart home business. It says that this deal will help define the future of home.
Social media company Reddit is now valued at $3 billion following its latest funding round, which raised $300 million. Reddit plans to use that investment to improve its website and try and increase its digital ad sales. Reddit, which calls itself the front page of the internet, is said to have more than 330 million average monthly active users.
Well, you know about the dogs of the Dow, but what about the Dow dinosaurs? Now, these are companies like AT&T, General Electric, General Motors that were once highly regarded components of the Dow Jones Industrial Average, but are no longer. And while most of them were down sharply in 2018, they have done very well so far in 2019. Can that last? Joining us tonight, David Nelson. He's Chief Strategist at Bell Point Asset Management. David, good to see you. Welcome. Thank you.
Thanks for having me.
And we should give credit to Barron's. They ran a story about something like this over the weekend. What happens typically when a company is taken out of the Dow? What happens on Wall Street then?
Well, it's something of a washout, you know. And to be fair, you know, when Dow Jones actually takes a stock out of the index, likely a lot of the bad news is priced in. In GE's case, you know, it's down 80%, you know, from the highs of 2000. So a lot of the sellers are gone. And when the index funds for the Dow actually kick it out, now you have a big flush. So what happens in the following year is very often any good news at all is enough to drive the shares a lot higher. And in some cases, like a GE, that was pretty dramatic.
It has been very dramatic. What about AT&T?
You know, AT&T is probably up the least of them all. It's up
Right.
You know, marginally this year, less than the market. I'm not that excited about AT&T. Yes, it has a great dividend, a lot of free cash flow, but historically has made a lot of very bad acquisitions. And one in particular, DirecTV, was just an enormously, will prove to be an enormously unprofitable choice for them. I think they're going to end up this is going to be looked at as a big error.
Then there's General Motors, which has had a very different journey from those other two companies we just mentioned. They went into bankruptcy with the financial crisis. Then they reissued stock. It's been sideways since they came out in 2011 or thereabouts. But you like this company. In fact, I think you own shares of this one, don't you?
We own shares. That's true. We own shares of this company. It's the one I like. And for the following reasons, Mary Barra gets it. I like this CEO. I like this management team. I think what she understands is that right now there's about over 80 million cars produced annually, new cars every year in the world. We're just moving into another world. We're not going to need that. It's not an efficient use of capital. The average automobile sits unused 23 hours out of every day. We need a different plan. And that's starting to happen. We're moving into a new society, an on-demand world, an Uber-like world. And I think she understands that. I think cars of the future will be on the road a lot longer, and we're going to need a lot less of them. I think they're gearing up for that, so they're retrenching here. They're making their footprint smaller. They're reducing capacity. And I think they're going to move into next generation vehicles. I think it's a very smart move on their part. All
right. There we are with three of the Dow dinosaurs tonight. David Nelson with Bell Point Asset Management. Thanks again for joining us.
Thanks for having me.
Investors cheer Norfolk Southern's new strategy. That's where we begin tonight's market focus. The railroad operator said changes are being made at the company that will result in an increase in productivity, efficiency, and sales growth. The CEO says that lower costs will help it deliver stronger margins. It's also aiming for revenue growth at a compound annual rate of 5% through the year 2021. Norfolk Southern was up 3% today to $176.95. Restaurant Brands reported better than expected earnings along with strong same-store sales figures. The CEO says the company's focus on technology, delivery, kiosks, and its mobile app has started to pay off. The parent company of Burger King and Tim Hortons also raised its dividend. The shares rose more than 1.5% to $63.72. It touched a 52-week high during this session as well. And the video game company Activision Blizzard reportedly is planning to cut hundreds of jobs. Bloomberg says Activision, which makes the popular games Call of Duty and Warcraft, is facing slowing sales and increased competition. The layoffs expected Tuesday, when the company reports earnings, are said to be aimed at lifting profit and centralizing operations. Activision shares fell more than 7.5% today to close at $40.11. They hit a one-year low during the session.
Morgan Stanley is buying Solium Capital. This is a Canadian company that prepares stock plans for startups. Price tag, nearly $1 billion, and the deal gives Morgan increased exposure to more potential wealth management customers. It is Morgan Stanley's largest acquisition since the financial crisis in 2008. Shares dropped more than 1.5% today to $40.21. Drug makers Sanofi and Regeneron are slashing the price of their injectable cholesterol drug Praluent by 60%. Now, the original price tag of $14,000 a year will now be cut down to just over $5,800 a year. The out-of-pocket cost for Medicare Part D patients will now be between $25 and $150 per month. By the way, rival Amgen made a similar move with its competing drug Repatha back in October. Sanofi was down a fraction today to $42.33. Regeneron rose slightly to $408.51. And while we're at it, Amgen was also off a tick today to $185.79. Chegg reported a rise in profit and revenue in its fourth quarter. The online education company said that its subscriber count grew by more than 30%. So as a result, it is increasing its revenue guidance for this year. And that sent the stock higher in initial after-hours trading this evening. It finished the regular session up 1% to $34.80.
It used to be that older Americans would sell their homes and downsize once the kids moved out. But today, an increasing number are choosing to age in place. And that is having a big impact on potential homebuyers of all ages. Diana Olek has our report.
64-year-old Louis Tenenbaum is busy building an elevator into his small Maryland home.
I took this middle line between the upper levels and the lower level and opened the shaft, which I will put a lift in so that this house can really be an aging in place friendly house.
Tenenbaum says he plans to grow old in his current neighborhood as long as he can, and he is not alone.
People want to age in place because they love their homes. It's their chief investment. They love their neighborhoods and their communities, and they love the control that they get in their own house.
The trend, however, is removing an estimated 1.6 million homes from a housing market already in critical need of more homes for sale, according to Freddie Mac. That is about the same number of new single-family and multifamily housing units built each year.
There's a stalemate. You know, we can't get enough housing for the couples that want to put their kids in good public school systems.
Real estate agent Jane Fairweather sees the problem every day. Not enough listings for the high demand of move-up family buyers. But she says it's not just homeowners like Tenenbaum choosing to stay put. Others have no choice.
For some people, it's because there's nothing affordable to move to, so they've decided we have to stay here.
And given how pricey today's market is, in some cases, the math just works in favor of staying put.
But if they have to spend another $1 million in order to get 1/4 of the space, that house starts to look reasonable. And the maintenance on it looks reasonable.
This trend is likely to grow, especially as more homes are renovated to make it possible. Tenenbaum lowered a kitchen counter so he could sit and cook if he needed to, and also moved switches to make them more accessible. So you planned out for everything?
Well, I hope I've planned out for quite a bit.
For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about the aging in place trend, you can always head to our website, nbr.com.
Coming up, should the rich pay more in taxes? It's a hot topic in Washington right now, and it's been done before. As we all know, it is tax filing season, and no one wants an unpleasant surprise, but apparently that's exactly what some early filers have been getting. Sharon Epperson is with us tonight to explain what is happening and maybe how to avoid the same scenario next year. And right away, what we heard today from the IRS is that the average refund is smaller than it was last year.
It is smaller. We've talked about all the tax law changes and the impact that that could have on your taxes. Another big change was a change to the withholding tables. So people were not having as much tax withheld. And so it's not necessarily that they're paying more tax, but they may be and may not have had enough withheld, and that is why they're seeing an impact on that refund that they expected to get or maybe may even owe. The difference that we're seeing is significant. If you look at what
whoa, that is.
the average refund was at the end of February 1st, the first week that you could turn in your tax return, you're looking at $18,000, a little bit over, $1,800, a little bit more. That other number is showing you what it was that first week in February last year, but the average refund overall last year was over $2,800. So it's a big difference in what people are getting back.
So which taxpayers, maybe segment of taxpayers, is most likely to be affected by this?
It's the ones who are probably under withheld and so did not pay enough tax throughout the year and have that withholding problem. And so those are people who itemize and do not have dependents, people who live in a high tax state because of the cap now on the state and local tax deduction of $10,000, and people who have unreimbursed business expenses because so many of those itemized deductions and expenses are no longer or are limited in terms of being able to be deducted and be claimed. So that's a big change for a lot of people.
So what do you do to make sure this doesn't happen next year?
So like, now what? So now what?
Right.
So this is what I did. This is what you need to do.
Take a look at your W-4, right?
Exactly, exactly. And so what you need to do, there's a withholding calculator at irs.gov. It is very helpful. Have your pay stub, have your tax return ready so you have all the accurate information to fill in that and see what it says in terms of what your withholding should be. If it doesn't say that right now on your W-4, go to your employer, change that W-4 form, make sure that you're in a better place for 2019 than you were for 2018. There's really nothing you can do now to dial it back if you didn't have the right withholding tax taken out, but you can make that change for 2019 if you go through those steps.
And it's early in the year.
And it's early in the year, exactly.
There's time.
Exactly. There's
Sharon
time.
Epperson, as always, thank you very much.
Well, not only are taxes on everybody's mind, but so are tax rates, especially now that some lawmakers are talking about hiking them on the wealthy. And as Robert Frank reports, that is not a new idea.
New proposals for taxing the wealthy are being called radical, socialist, and extreme, even by some Democrats. But the plans being floated have some precedent in American history. Representative Alexandria Ocasio-Cortez discussing a top income tax rate of as high as 70%, which is almost twice the current top tax rates. Conservatives say her plan, and similar ones from Senators Warren and Sanders, threaten economic growth and investment.
Tax rates matter, and they matter a lot. And when you get a lower rate, broader base flat tax, economic growth ensues, and a lot of the benefits go to the poor, the minorities, the disenfranchised, those people who are getting jobs right now.
But America has seen much higher rates before. Between World War II and 1980, the top tax rate was between 70 and 91%. Bernie Sanders' estate tax, which would lower the exemption from the current $11.4 million to just $3.5 million, would mark a return to 2009 levels. But some say taxes on estates and wealth are needed to reduce growing inequality.
Let's be clear about where the rates are. They are historically low, much lower than they were for the 40 years after the Second World War. And as a member of that 1%, 0.1%, I can tell you, I can afford a little bit higher taxes, and it would make my life better.
All of which may help explain why a majority of Americans support higher taxes on the wealthy. 3/4 of those polled by Politico and Morning Consult support increasing the top tax rate to 70%. A Fox News poll found that a majority of Republicans even back higher taxes on those making more than $10 million. Now, what none of the candidates have mentioned is that the top 1% pay the highest share of income taxes in history, close to 40%. For Nightly Business Report, I'm Robert Frank.
And before we go, one final look at the day on Wall Street. Kind of a wait-and-see day with the markets very much focused on the trade talks that will be going on in Beijing this week and the potential shutdown talks that are going on in Washington, beginning right now, as a matter of fact. The Dow fell 53 points. The NASDAQ was up 9, and the S&P up almost 2 points today.
And on that note, that will do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.